talk about a little bit more conceptualness as we go through this audit risk model, right? This is an equation, right? If you look at it, it's an equation. So can this be 0? No. Why can't it be 0? Angela? Because what? Auditors are humans and they make mistakes. I like that. Very good. What else? Why can't it be 0? It would make all the risks 0, right? And I can't, there's always a risk. Yeah. Because if one of them's 0, it would make to balance the equation, they would all be 0. Daniel? You saying the same thing? Yeah, there's always going to be risk because if, yes, this is an equation, but remember what the definition of this was. It's the risk that the auditor gives an inappropriate opinion. That risk will always exist, even if you have the best planned procedures, right? Obviously, there's more risk if they're poorly planned, but there's always going to be risk. Remember I told you that, what does this need to be in order for the auditor to give us reasonable assurance? Daniel? At an appropriately low level, acceptably low level, etc. So what is that? What's an acceptably low level of audit risk? It's absolutely relative. Tanya? There's actually no standard for an appropriately low level, right? Because even in the audit, the PCAOB standards, or somebody a question. So the auditing profession has no official standard for acceptably low. Like we're not going to say it's 0.05 or 0 or anything like that, right? Except that it should be appropriately low, right? We'll come back to that as we talk about how we manipulate this. But before we go there, we're going to have to understand 2 terms that we'll use throughout the semester, so we might as well get them out of the way now. One is a significant account or disclosure, right? As we get into the cycles, we're going to be talking about which accounts in the revenue and collection cycles are significant accounts, right? And within those significant accounts, which assertions are relevant, remember that term, relevant assertions to that significant account. So what is considered a significant account for disclosure? Would revenue be a significant account in the revenue collection cycle? Would petty cash be a significant account? What's the definition of significant account? I can just put it on your quiz. Nikki? Any account that has a possibility, a reasonable possibility of having a material misstatement is significant, right? It matters to the audit because the auditor needs to detect material misstatements. So if there's a reasonable possibility that that account could contain a material misstatement, it's significant. So let's break it down for a second. Bring some terms into, or numbers into this. If materiality for cash is set at 10,000, and you see a petty cash account that has $100 in it, would that be considered a significant account? No, because could it contain a material misstatement? No. If materiality is set at 10,000 and it has the $100 account, it couldn't reasonably have a material misstatement in it. So it's not considered significant, right? The auditor does risk-based audits and they have to go where the biggest, spend their majority of their efforts where the biggest risks are, right? They're trying to detect risk, or they're trying to detect material misstatements. So if this account couldn't possibly have a material misstatement in it, it's not significant. right? So it goes with Nikki's definition. Any account that has a reasonable possibility of containing a material misstatement is significant. Same with disclosures. What about a relevant assertion? What is that? Pretty much the same definition. If there is a reasonable possibility of containing a material misstatement without controls, then that assertion is considered relevant, right? Like existence of cash. Is there a reasonable possibility for a multi-billion-dollar company that cash could have, there could be fake cash on their books, right? Then yeah, that assertion is going to be relevant, or yeah, relevant. Okay. Let's talk about the audit risk model. So before we go to this, I want to show you something. These next 3 slides are pretty much the exact same thing. The only reason they're in there is because some of you guys learn differently, right? Some of you guys are pictorial learners. Some of you guys are analytic, and some of you guys just need words, right? You might be audio as well, right? So we're about to explain these 3 slides. I just want to explain them first so that when you're studying, you can see them, okay? I'll start with this one. This is how I think of it, right? So you've got the audit risk model, right? You've got inherent risk. Remember, we're going to keep that as a constant, so it is what it is. We've got control risk, we've got detection risk, and we've got audit risk, okay? So as we go through the conceptual model, if you have access to your slides, flip back and forth as we answer these questions, right? Same thing here. We're going to get conceptual and understand how these things relate to each other. This might help you.